And so when you go to a school like Michigan, when you go to a town like Chicago, I encourage join a bunch of organizations, get to know people, join a sports league, do anything you care about where there's a community. That matters. I am telling you, every single job I've got since that point is because of someone I knew. Absolutely. Never stop.
Hey everyone, welcome back to our new episode. Today we're really happy to welcome our 10th guest speaker, JD Cronin. He is a seasoned risk manager with expertise in financial services, managing $100 million and achieving a 22% return on equity annually. JD has held significant roles at BMO Financial Group and William Blair, and provided expertise to the Federal Reserve. He holds an MBA from Chicago Booth and also a BA from the University of Michigan. Thanks, JD, for joining us today. I wonder, to begin with, could you tell us a little bit more about yourself?
Sure. So I'm JD, and I was slated to go to the University of Michigan very early in my life. My dad was a resident at the University of Michigan. So when it came time for college and I started looking seriously around schools, I applied to 4 or 5, but I pretty much always knew I was going to go to Michigan. And so I was accepted, I was elated, and I matriculated to school in 1982. That was a long time ago. Yeah.
How was your Michigan experience helpful for your career? Especially, how did you make up your mind going to Chicago?
So I was speaking about the economic staff, and the Michigan kind of school of thought was very center-left, kind of very political, intervening, Keynesian type thing. Keynesian was John Maynard Keynes, who was a very famous economist in the 30s. It was very much for like government intervention, stuff like that in the economy, and that was after, kind of the failure of what had happened in the 20s and in the 30s and the Great Depression. So there was a very massive, and that was for like a 30, 40 year period that Keynesian economics, where the government would get involved and do things, was of the moment. However, in the late 70s, things were failing. That wasn't kind of working anymore. Jimmy Carter was president prior to Ronald Reagan, and we got into this very, what a period called malaise, where things were just, unemployment was super high, 10, 12%. Inflation was like 18, 19%. It was like very difficult time period, and America politically had kind of lost a lot of luster after the loss in Vietnam, and then things were going on. The Soviet Empire was still kind of going on with the incursion in Afghanistan. It was just very difficult time for America, relatively speaking, in terms of that. That said, so this whole kind of sea change happened, and I was talking about the economics. There was a guy named David who was a brilliant economist, and he was like this whirling dervish, and he ended up being my mentor at the University of Michigan. I took 3 classes with him. Absolute genius. I've never seen a guy put chalk up on a chalkboard like this guy. It was just like a typewriter. It was like, and he was shocking in terms of he was just very different, and he was like this kind of new breed of economics thinking, what was called the so-called freshwater thinking, which schools of thoughts were Rochester University in New York, University of Chicago, versus the coast, the Harvards and the Stanfords of the world, who were more kind of traditionalist. And there's this kind of very so-called neoclassical revolution in economics that really like go back to basics. We need to go back to supply side economics came out of this, and so there's this very thing, and I glommed onto it because I was kind of inclined anyway, and it's like, well, this isn't working, this stuff isn't working, so let's do that. And so David Ashour and another woman named Carol Lown in Michigan, they were kind of these young, very aggressive, super intelligent. I think they were well regarded with the department, whatever they were regarded like in terms of their political philosophy. A bunch of us just kind of like, these are the people I want to be associated with, and they were just kind of like new monetarist, and kind of Milton Friedman was kind of back in ascendancy, who was a very famous economist from the University of Chicago. And David took me aside one day and he goes, well, what do you want to do when you grow up? And I go, I don't really know. And he goes, you ought to think about a PhD in economics. And I did, but he said, but I really think you should. I looked into the PhD program, and I'm very glad I did, and I don't think I was particularly an academic type. So instead I applied to business school at the University of Chicago. And so David basically got me directly over there. And he knew all the right people already over there. I applied. This was back in an era you could apply to business school and get accepted and go straight away. You can't do that anymore. No one's going to take you. They might take you on a deferred basis and say, hey, in 5 years when you go do something, let us know. We'll be happy to take your money and you can come on in and join us. Back then it was different. And Chicago was a very academic place. It was, and still is. It's very much known for that. But they had a guy named Gene Fama who won a Nobel Prize, Ken French who's the chair at Wharton. They had like three or four like Nobel Prize winning economists already on there, and they taught in the business school. They weren't just doing PhD work. They were doing like real world. And the thing that was I wanted to eventually go out in the market and do something. I wanted to trade, and so I really thought about that and how that applied to me. And the program was very rigorous. It was a very rigorous program. I learned a ton from it, and a ton of my colleagues came out very, very smart class. Did a lot of great things, and people then were kind of like investment banking is still very hot. Everyone, a lot of my peers did that. A lot of people traded. A lot of people wanted to money manage, and so Chicago was putting out. Our entire class was when you went to Chicago, you went to study finance, and so I studied finance and econometrics, and the latter was helpful. Econometrics gave me an appreciation and understanding the limitations of quantitative stuff. Heavily quantitative school, very, very much so. But I was all set up by my stuff at Michigan and David Ashour to do this, and so he was hugely influential. Unfortunately, David passed away several years ago, but he was a very influential guy in my career.
When you're coming out of undergrad school from Michigan and came to business school in Chicago, what were you thinking when you were doing the business school program in Chicago?
There was a cohort of us who were direct undergraduates, so a younger portion. We were certainly more younger demographic than the average class at Harvard or something like that. So if you were smart and you were good enough to get accepted to Chicago, you were considered pretty smart and you could do something there. I remember like walking out there and anyone was talking about, what are you going to do for a summer internship? Yeah. What do you mean? I don't even know anything about this. And that was all your entire focus. Literally from that day on, you have to get an internship at a place. And obviously that's trickled down to undergraduate as well at this point.
Listening to your history.
It is like listening to history. It is history. I know it is. But I have a real appreciation. So I worked on the foreign exchange desk when I first got to, and First Chicago was a good foreign exchange bank. And we fought really well above our weight. We had a very good spot desk. And I was very lucky because we had an options desk that was aligned with a place called O'Connor and Associates. Very important firm, very important to the history of kind of like trading firm. And we partnered with them. And so I was more or less trained as an O'Connor guy, and these guys were fabulous. These guys were really smart, really just incredible guys. A couple of the principals of the firms were like Fisher Black's research assistant. Like we're talking really creme de la creme people here. And we had a partnership with them, and I really got schooled in the O'Connor way, fortunately. And so I got a world-class post-education of grad school about the options market, which is involved. Options trading is, it's a very famous Black-Scholes formula, and it's very analytical. There's lots of ways to manage risk in these portfolios, and it depends on 5 inputs to kind of price an option. Stock price, the volatility, the interest rate, dividend, all sorts of stuff. And they were world class, very important firm here. O'Connor, Chicago Research and Trading, and this town, particularly Chicago, was completely based on that. The futures and options market, which became incredibly important to the overall financial picture, was happening here. That was also a big reason I came here. It wasn't just, I was very set in my ways. I was going to stay in the city of Chicago and start my career here. I wasn't going to New York. I wasn't going to Hong Kong or other places that were happening, which definitely were happening. But Chicago was the derivatives capital of the world. There was a very famous incident in 1993 where the entire financial market stopped because we had a flood in the basement of the futures exchanges that literally no one could trade. And so when you can't trade the derivatives markets, which are driving in a way the cash markets, stuff just like completely stopped. That's how important the city was. And that was like in 1993. And you might argue that was kind of the absolute peak of Chicago's power. There used to be a big fungibility. People would move back and forth between New York and Chicago quite a bit. It was there. First of all, the banking industry was much smaller. There were many more banks who were much smaller capitalized. Now everything is. JP Morgan was probably the 10th largest bank in the country back then, and they were much bigger. Citibank was huge, and the difference between a commercial bank and investment bank, where there was a hard line between them because the United States had the Glass-Steagall Act that didn't allow. Because Europe and Asia, they never broke one apart. We broke apart our banks, and created Morgan Stanley out of JP Morgan, and JP Morgan is JP Morgan, and so all that stuff. So the banks were much smaller capitalized, and there were many more banks in both Chicago, New York, West Coast, and so there was a lot more mobility going back and forth there. And then slowly but surely, the New York banks started growing, kind of never looked back, and Chicago didn't have. First, Chicago was like the 5th or 6th largest bank in the country, but couldn't keep up. We bought a bank in Detroit called NBD, and then we partnered with Bank One, and was very lucky that in 2000 Jamie Dimon had left Citibank, and we got incredibly lucky. We got literally the best guy in the business to be our CEO, and he made everything way different, and he's that good. Jamie Dimon still to this day, I think he's the best guy in the business. I don't think there's anyone close to him. I think he's that good. So I was really lucky, and he was really good to me in my career, and a lot of people in our bank. And so the thing about this business is it always changes, and it never stops. I don't care who you are, it never stops, and someone's always trying something different, something faster, something better. And it's always been a complicated business, but it's a really complicated business now. A lot of governance, a lot of agencies, a lot of regulatory stuff you have to contend with. The rise of the fintechs, have changed things a lot. They have great technology. They're getting close to the edge of being banks, or certainly could be in the vicinity of being overseen by regulators, which is a whole thing. That is you just don't enter into those kind of worlds, being governed by the OCC or the Federal Reserve or something like that lightly. That's a big deal for people to do that. And so that's kind of what I focus on a lot these days, and that's why I was talking about experience. It's like, if you hang around long enough, you can see enough that you can at least might be able to intelligently help people, navigate their issues.
We know that you have a ton of experience in financial institutions. So how does different experiences lead you to risk management?
Well, that's a really good question. I ran a trading desk. I traded pretty much every commodity under the sun at some point, and I'm at my heart as a derivatives risk management. And when you're a derivatives person, you see a lot of things because you have to deal with the underlying asset. You have to deal with the derivatives market, the dynamics of all that stuff. It's always interesting. I mean, that's the thing. I still do this because it's interesting. Up until 2014, I worked on kind of like the so-called sell side, or place of people who are selling derivatives or managing derivatives or trying to make money in derivatives or whatever. And then I did something on my own for a year, and then a friend reached out to me from the Federal Reserve Bank of Chicago. And I'd had very good relationships with people at the Federal Reserve Bank of Chicago who had regulated us over time. And I knew some people there. And this was just after the financial crisis. And the Federal Reserve Bank was given enhanced powers, and particularly in the derivatives markets, which was still mostly considered Chicago's kind of area. So the Federal Reserve Bank of Chicago was asked to put their efforts towards regulating the so-called clearinghouses. This is a very important, most people don't know about this kind of part of the market. There is a whole industry behind what so-called clearing of trades and derivatives, futures, options. They're called central clearinghouses. The central clearinghouse is who sits between you and me. If you're a bank and you're the other bank, basically there's like, the whole system was built like, I don't necessarily have to trust you to deliver things. Me, the clearinghouse, stands in between you, and I guarantee this trade, and you're guaranteeing me the other side of the trade. And you and I are going to settle up every single day, every business day, and that's how it works. And so every night after trading closes and the exchanges and all this stuff, the central clearinghouses are making sure that you're giving me the money, I'm giving you the money from this person, and all that stuff. So the infrastructure for all that stuff was very important. And clearinghouses have a sterling reputation of not failing, unlike over-the-counter markets or things that have happened in the past. And so with that, we want to make sure that the Federal Reserve or some regulatory agency was ensuring that that continues to be the case. And so this group was created where I was invited to join, called the Financial Markets Utilities Group. And so I became on the regulatory side, which was something that was new to me. And it was great, it's because I learned a lot. The Federal Reserve's got a great mission. They got a lot of good people there, and they were pretty smart, so that was good. But I also reminded people, like, no person at a bank, in a major bank, wakes up and says, how can I please my regulator? They don't do that. They're worried about other stuff. If they operate within the rules and their organization is set up correctly, they will play well with regulators because they do the right things. They strong audit trails. They have very good processes. And I think that's one thing that I've picked up on the last 10 years is like, those things bore the heck out of people, but it's the things that really get you into trouble. That if you don't do the right things, if you say you're going to do a process and you don't do the process, guess what? You're going to get written up by a regulator pretty quickly, and it's going to have some real blowback for you. So doing the right thing, and the United States earns a big premium because we do the right thing. Our capital markets are the best in the world. The UK is second, in my opinion, and the rest of the world is not as good. And it's because, and we get a premium because of that. Our assets, our markets are valued because we have a very strong regulatory, construct around all this stuff, and we do things right. And that's worth it. That's what you have to kind of remind people, like, yeah, I know this stuff is painful, it can be expensive. It costs a lot of money to run a proper compliance regime and do all the right things. But I'm telling you, I get more calls about going wrong or can you review this process for us because, hey, is it logical? Do you have an audit trail? Do you have all the things that said we do exactly what we say? And I always tell people, like, the biggest risk you have in this business is saying you do something and not having the proof that you did do it. That's kind of where you get into trouble. And then that's how regulators think anyway. You say you do this, we see no evidence that you do. That's a problem. And they're right, that is a problem.
So you're also like the head of investment risk management in William Blair, and you have a really large team. So what do you usually tell those junior people about their work?
Something I learned from having really nice and good people above me was like setting a tone. It's a real honor to have people work for you. When I was managing people, it was really important that they felt they had a voice. No one knows everything. I thought like Jamie and his group was really good at like next person on deck. They had succession planning in their mind, if not always, explicitly laid out. Who's next to do the job if something happens, which does happen. People's health changes or can't do what they do, or they're just burned out. They can't do it anymore. It's hard. These jobs are taxing. They take a lot out of you. And so when you're a risk manager, pretty much your job is to be a professional warrior about everything, and what you're trying to do is kind of size the probabilistic events. That's a 3% chance of happening. But if it's 3%, I could lose 100%.
Yeah.
And so quantification and probabilities play a big role. If you have a little bit of a twisted mind about what can go wrong.
Just want to chat a little bit more about your recent role. You were the senior advisor at BMO.
Yeah.
And I wonder, what is your objective there and how do you approach them?
BMO is a very old bank. It's been around since pre-revolutionary America. So it's been in business for a very long time and obviously seen a lot. And I used to trade the Canadian dollar options market, and I was eternally frustrated with dealing with that market. I was considered very much an insider market. If you weren't Canadian, forget it. I'd never worked for any non-US centric bank, which I think is also a big deal, because when you work in a home office, of a major bank, it's really a world of difference. The decision making happens there. As a BMO, I was doing what's so-called enterprise work. I was in charge of enterprise, the risk appetite. Risk appetite was a product that kind of grew out of the financial crisis in 2008 and 9. And it's a statement where you gather a bunch of metrics about how you express your risk and how you take that risk. So it's a bunch of quantitative measures that are kind of put up in a mosaic of how are we doing about what we say our risk limits are and where we actually are. It was definitely a little bit different for me, but it also gave me perspective of having provenance over a lot of things, stuff that I normally wouldn't have done. It's a very complicated business. There's a lot to contend with, and you gotta be familiar with kind of the rule set you're playing with, so you can do all the right things. And so what you were doing was producing a mosaic of how's the bank doing against what it says its risk appetite is. And the risk appetite is something you say, what risk am I willing to take to achieve the goals I have, usually profitability and all this stuff. And when I get in this thing, I've got to take some remedial action.
Would you suggest to young people to go to this area?
That's a good question. I believe being a practitioner is always a good example. Did you make money? Yes, I did. Great, keep doing it. That's kind of the message, more or less. Now, you got it. Things are different from when I first came up. There's a lot more control, and it's good. The regime team for like making sure you get validation, you have broker quotes, all the stuff like to support if you're valuing a portfolio. That's all the inputs are via. They're all verified and all this stuff. Yes, third party independent said the spot price is here, the volatility is X, the interest rate is Y. Everything goes into the options price model is. I didn't have anything to do with it. It's just that's where the market is, and so that kind of stuff is invaluable. So being a practitioner, I think, is important, because I think it gives you more when you have something attached to your name, profit and loss. That's really how you take ownership. So you're going to care about something. You're going to I don't want to get burned because I got burned today because my gamma position ran me over. Mm-hmm. I don't want to do that. Or I'm going to switch my thinking to, instead of being short, I want to be long. Mm-hmm. And what I have to do, I have to hedge a lot more if I do that. That's okay. Do I like that? Do I want to do that? And so there's this, when you have profit and loss associated with your thing, it just means something more because you're incented.
Knowing that you're working on a consulting firm recently, how did you use all your work experience to help those firms to figure out their problem, and what kind of business are you working with? I joined recently a partner of mine to do consulting. And in a way, my whole career is offering your opinion about something, I suppose. And you hope as you get older, it's more informed along the way. And so one thing I think I can add to the equation is listen, I know what it means to run a business. I know what it means to kind of have a P&L. I know what it means to have pressure and people looking at you and trying to deal with a board. There's a lot. I've dealt with a lot of that as part of a team and otherwise. And so I think when you can effectively say, I know exactly how you're feeling, and mean it, and say, hey, I experienced a little bit of this and I understand what you're going through with maybe a colleague or a board member, or you're in a situation where you're moving into a new area and that's going to invite new people looking at you, regulators, something else. The sum of my experiences is what I think I bring to that. So when you're able to do that with it's credibility. So it's one of these things where I think if you get down to it, it's can you bring something credible to say? And like I said, when you're as old as I am now, you're kind of 35 years in business. I've seen most of everything. Yeah. I'm curious with all those trends, markets, technologies going, how do you keep yourself updated for all those information?
I think a couple things matter in your career. Get a mentor, have someone who takes an interest in your career. You are going to make mistakes. You are going to make bad decisions, and it's their job because they care about you to steer you. I had tremendous mentorship in my career. 2 or 3 people really mattered a lot to me. I got a lot, I wouldn't say trouble, but I could have walked off a cliff easily without these guys. And so they did a good job for me because they cared about me, which was nice. 2, networking. I did a lousy job of network. I did a great job inside my organization, but when our bank got bought, I felt all my power was inwardly focused. It was not outwardly focused. And so when you go to a school like Michigan, when you go to a town like Chicago, I encourage join a bunch of organizations, get to know people, join a sports league, do anything you care about where there's a community. That matters. I am telling you, every single job I've got since that point is because of someone I knew. Absolutely. Never stopped. So mentoring, networking, and then to your question is like, I love learning. I still love learning. I didn't program till mid-90s. And I started just like, I need to improve myself. I just jumped in and learned. And I programmed in Visual Basic originally, which was kind of the Excel spreadsheet stuff. And I went into like, doing Python and stuff like that, which was one of my good friends really showed me about. And it's been eye-opening. And coding's a lot easier than it was back then. You don't have to be the coder, but if you can explain something to someone, say, I want this to do this, this, and this. And I think with the generative AI stuff, you can do anything. Yeah. You can literally give me the Black-Scholes formula, provide the American style options formula. All this stuff is at your fingertips. It's kind of remarkable. It's like, where was this when I was like 25 years ago? This would have been great. But yeah, it's been a complete evolution. So the long answer to the question is, when you're going through your career, being passionate, learning, all this stuff's really important. At the end of the day, you ask yourself, am I productive? And so can I get stuff done quickly? Can I get a fairly responsive answer back to someone who's asking for it? Be accurate, give them good information, and move on. So everything is kind of a self-investment concept, and you should think about that and be honest with yourself. If you went to school in Michigan, most kids are pretty motivated, and so they're kind of go-getter alpha types. That's just the way it is, and so you're used to being around people like that. But the question is, can you dial in to yourself to know what works for you and what doesn't? And as we were talking earlier about the younger generation thing, I think that's when my daughter somehow was under the impression we were going to pay half her rent in New York, which I quickly disabused her of and said, no, that's not. The whole idea is to get you out of the family finances and be on your own. That's our gift to you. And she kind of, okay, you're right. I know I'm right.
Yeah, definitely. I think the last thing we want to chat for a little bit before the rapid fire question is, what do you wish you could have known when you were in your 20s?
That is an excellent question. And I've contemplated that question before. I think any issues I had were probably assumptions about people feeling the same about something the way I felt about it. When I thought about putting people in certain positions because at the time I thought they could do it, versus perhaps something nagging in the back of my mind saying, are you sure? I should have asked myself a couple of times in a couple of situations, how confident are you right now in what you are? Instead of listening to myself a little bit more. It was more about people, I think, than anything, because at the end of the day, as I told you, people still matter. And so there is a kind of trial period in showing people what you can do and coming through in the end and doing good work. And I think one thing that people don't do enough of is being very honest with each other. I thought you did this great. This was a great process. I really like the way you thought. Got it done in time. That was great. I think you could have done a better job here, and here's why I think so. And then you got to have the conversation with someone like, here's what I think we could have done better. And you use a word like we, or how could I have helped you do a better job? And so my regrets of anything or thinking about like how I would have changed it usually involve people and people I care about and I worked with and valued highly. You're going to be really connected with people that you work with as much as anyone. You don't spend nearly as much time with your friends you do in your 20s. So I guess I come down to like some personal things about like, I wish I'd handled that differently or something like that. So it's not so much like a categorical, I would have done this or I would have done that. It's more like more personal situations, I suppose.
That is the end of this episode. Thanks for listening. We wish to see you in the next episode.